Welcome to Revere Asset Management's Your Money with Danny Stewart
The market will always overshoot to the downside and to the upside.
and Don Vandenbord.
Because it's not how much you make in the markets, it's how much of that you can keep.
Does your kitty meow or does your kitty roar? Well, if your kitty roars too loud, you might just attract the attention of Pelosi and all the Democrats and Republicans insider trading in D.C. You're peeing in their sandbox, and they don't like it. Whenever people raise attention to insider trading, everybody always compares it to Congress, so they want to fly under the radar. But anyway, they are going after Roaring Kitty, at least the regulators. And are you paying for shelf space at Fidelity? The shakedown is occurring, and Fidelity is going after the ETFs to get a big piece of their internal fee of the ETFs. And if they don't agree, they'll just charge you, the consumer, $100. Now, and you thought you were the client. You're just the customer. And by the way, you're just the product. And by the way, folks, trades aren't free. They're just undisclosed now. It could be $2 or $20. You just don't know. I kind of miss the days of $4.95. Now, speaking of shakedowns, the stock market is moving to Texas like everyone else. They're fleeing New York City. We need a wall in Texas. Oh, I'm just kidding. Come on. It's a bit of humor. I hate to say it, and I told you so, but remember that story about diversification and the broken 60-40? Remember I was telling you that they had the 60-40 correlation. Stocks and bonds were positively correlated, and therefore your benefits of diversification don't work anymore. So you got to do these safe private placements, these illiquid stuff, or you need more international exposure. You need exposure to things that aren't already being supported. Well, I told you it was all about liquidity and shoring up the sell side, the parts of the market that aren't working well. And we're going to talk about that. I just found an article with these private REITs and U.S. dominance, and all of these articles are in the show notes. And speaking of the mailbag, if you ever got a question, you can send me an email and I'll bring it up. But the first paragraph of a mailbag I got said, "You did a great job covering the IBD connection with Dow Jones during your discussion a couple weeks ago, reminding folks to be careful where the recommendation comes from and the incentive behind the message." Well, very quickly, there is an article now talking about the U.S. dominance in global equities overdone. He said that weak diversification, you need overseas, you need these other things besides U.S. large cap. The problem is that's where the money is, but they want you to help international. They need money in Europe. They need money in places that are having troubles and liquidity. Right now, the ECB just came out, they're lowering rates. They're trying to juice up their system. Here's another article. KKR injects capital into private REITs. So, folks, these non-traded REITs, they're illiquid. And the whole argument is that they're less volatile than public REITs. Folks, they're not less volatile. You just don't get daily pricing. So you just don't see the daily ups and downs. So if that makes you nervous, you don't get to see that. The problem with that is when you do have a liquidity crisis or you do run in trouble, all of a sudden Bob's your uncle and it's down 20% and you can't get out. That's the problem. In any event, that article a few weeks ago that I did on the show was talking about how you need to diversify away from stocks and bonds into these private placements. Well, one of their 3 recommendations was commercial real estate paper. All right. So knowing that, today this article says redemptions in non-traded REITs shows no signs of abating. People are asking for their money back. KKR just subordinated, put up $200 million of their own, of the partners at KKR's own money to support the net asset value of their non-traded REIT. Now, their non-traded REIT is only 3 or 4. It's a smaller REIT, and it's not nearly as big as a Starwood REIT, okay? And who's the other one? KKR, and there's another one. Oh, the Blackstone REIT. Those are much bigger, and they are also having a little bit of redemption issues, so they're slowing down their redemptions. Now, at Starwood, they're just reducing them. You're not able to get all your money out, okay? With KKR, they're still giving redemptions, but they're putting up their own money to meet those redemptions. If that keeps continuing, it could be a problem. But the point is, if you've got a way to measure where the money is, why do you want to be in these other areas that are struggling, whether that be Europe? And by the way, with the ECB lowering rates right now, Europe may actually become a place to invest and a place to put money. But up until now, and for the last 10 years, there was no reason to be in Europe when America was doing so well. That's the same thing with these private REITs. Why do you want the private REITs? Now, this article talked about Vandenbord, the public REIT, is being priced, and it was down 20%, while KKR was actually up 8%. Well, you're not getting real-time pricing. Now they're getting net redemptions, and they're having to reprice, and now maybe the private is catching up to the public. I don't know if that's happening or not. I just don't like the illiquidity associated with that and the non-transparency, but also the fact that you can't get out when it gets ugly. In any event, they're having some liquidity problems in commercial REITs. We've been talking about this for months and months, and it could be coming to a head now. So just be careful and always look by the article you read, always look at the source and always look at their advertisers and figure out where you need your money to be. All right, now, I also talked about Fidelity. Fidelity is actually shaking down. See, now that the mutual funds are becoming much less popular and everybody's converting to these very low cost ETFs, they really didn't have a sharing fee set up with Fidelity, a structure. They didn't have that firmly in place like they did with the mutual funds. See, all the mutual funds at Fidelity, they share a portion of their fee at Fidelity in order to be on Fidelity's platform. Now, and that's Schwab. It's the same at all the other places. But a big rock star mutual fund is able to negotiate a lower sharing ratio versus one that maybe not have such a long track record or not as good, and they have to give up more of their fee to be on Fidelity's platform. So if you're getting advice there, Fidelity knows which one they get paid more on. You think you're going to get the best one or the one that benefits Fidelity? I don't know. I guess it depends on your broker at Fidelity, and he is a broker. He's not an advisor. There's a conflict of interest. Okay? If you're getting advice directly from the custodian, there's a conflict of interest. That's why you should get conflict-free advice. In any event, lastly, I talked about this roaring kitty. This is an interesting development. So they are going after Patrick Gill. He's known as Roaring Kitty, and he kind of became famous during the COVID lockdowns where everybody, all these retail investors started trading at home, and he got on Reddit, and it's these meme stocks, and he started posting stuff. Well, he got on GameStop, and GameStop had a huge run-up. Well, now he's doing the same thing again. He's back on social media, and he's pumping up GameStop, which GameStop now, after he's pumped this stock up, has a PE of about 550. And they're selling video games that are, that's kind of a dying business because everything's streaming now. Okay, it's not like NVIDIA where they're making chips. NVIDIA with the 500 PE, and by the way, their PE is much lower. I'm not saying that. I'm saying I would feel a lot more comfortable holding NVIDIA with the 500 PE with triple digit growth rates that can bring that down versus GameStop, which, that's a pretty pricey stock. Anyway, love them or hate them, the regulators are really going after him, and E-Trade is now threatening to kick him off their brokerage. That's where he's got his money, some of his money. They're threatening to kick him off their platform. Now, folks, E-Trade doesn't kick off clients that are making them a ton of money because they're doing a lot of trading. So they've got some pressure. They're getting some pressure from the regulators, in my opinion, to take this guy on. So again, it's going to be an interesting takeoff. All of that is we're going to have to see how that plays out. I think they're going to go after him pretty hard.
We're going head to head with him, Dan. He's going online for the first time in a few years in 4 minutes, and there's 170,000 people in the waiting room waiting to talk to him. So just a few less than are waiting for our podcast.
Well, that's true. That's true. But I'm telling you, Don, I think he's hit a nerve. I don't know who he's pissed off in the regulators or in Congress, but apparently he didn't give a big enough campaign contribution to somebody. I think they wanted a handout. I don't know. The whole thing is crazy. Now, it's kind of it's a little bit of a gray area. I mean, he's not an advisor like us. We're a registered advisor. He
said nothing. Here he has not said a word until this thing, and this may be what gets him in trouble, is this appearance. But the only thing he did was he showed himself leaning up in a chair, and then he posted the size of his position. That's it. He did no recommendation. He said nothing about pumping the stock. That's it. He posted basically 3 pictures. One of him leaning up in a chair, which in gamer parlance means things are getting interesting, and that kicked off the initial run. Right. And then he posted his big account size between the common shares that he owned and options that he owns. And overnight, going into Friday, he was very close to becoming a billionaire. I know it's pulled back since then because they announced earnings early, along with a secondary offering, which is the right thing for them to do. I mean, really, this is a garbage company. But okay, now there's 250,000 people waiting for him in the waiting room. So
yeah,
and that's on Reddit. That's probably going to pump Reddit stock.
Yeah. So here's the question, Don. What was the reason behind him after he bought a bunch of shares and a bunch of options of posting these pictures? So let's take the extreme example. Suppose Warren Buffett buys a whole bunch of Exxon stock, and then before his quarterly holdings reports where he's got to issue, the day after he buys a bunch of stock, he goes out there and posts a picture, a meme on social media that he just bought 1 billion shares of this stock. What do you think that does to the stock?
That. He's done that at times with Oxy, and when he gets to a certain percentage of ownership, he has to file the 13F.
Well,
so it doesn't only at his quarterly meeting or his annual meeting. If there's things that happen in between the quarter, he mentions it.
Yeah, you're right. And he has to. Now, here's the interesting part. Roaring Kitty has now become the 5th largest shareholder in GameStop. So now, because he's considered if you become a 5% or more owner, there's certain rules about 5%, or if you can influence the company, the board, you become theoretically an insider. In other words, you fall under regulations, even if you're not like an advisor, you're just an investor. An investor that becomes too big or too important to the company, they have certain regulatory requirements. So he may have gotten, I don't want to say in trouble, he may have actually done a few things that are like a technical violation just because his account size grew so much. I mean, it's possible. It's going to be interesting to see. But they have
a certain amount of time before they have to file those 13F. So
yeah,
we'll got see. Some time. Hopefully he's got good lawyers to keep him on the right side of things.
Unless that stock price crashes, as long as he's taking some profits, which he should, he'll have the money to pay for some good lawyers. All right. So the other story I was talking about is Fidelity is now putting pressure on these ETFs because they lost a bunch of mutual fund revenue because a lot of people are going to ETFs. So now they're telling the ETFs, you got to give us, 20 basis points or 15 you got to give us 15% of your fee on that you generate from your ETF on our Fidelity platform. And if you don't, we're going to actually charge your investor a ticket charge up to $100 to invest in that ETF. And so one way or the other, you, the final end user, is going to pay for it. Folks, it's just like corporate taxes, okay? Corporations don't pay tax. They pass it on to you. That's the same thing with these brokerage firms and these ETF providers. Ultimately, it always goes down to you. All right. So we've got that out of the way. Where is my show notes, the mailbag? Hang on, I got my mailbag. I pulled it over here. So I got a couple different mailbag articles, and one of them kind of ties in to this article. Again, they're on the show notes. Some Americans live in a parallel economy where everything is terrible. Okay. And this is it's in the show notes. It's economy trying to talk about how the economy is good for quite a few people, but for some people, it's not very good. Look, folks, during the Depression, unemployment was 25%. If you were that 25%, you were dirt poor. If you had a job, you were actually doing pretty well. You were living in high cotton. So it really depends on your circumstances. But again, we've talked about this a lot in the past. The economy is slowing, and a lot of the economy and the jobs are government spending. It's because of government or the ancillary companies that are supporting government spending. Government spending now represents 30% of our GDP. That's a scary number. All right, so these are two mailbag questions I got, and I'm going to go over this very quickly. This on 65 MB sent me 3 articles all talking about the cost of eggs in the same week. It seems like this is a coordinated message. Seems like the media is actually putting out this kind of thing, because it was literally 3 different articles all about the cost of eggs. And so I'm not going to go into the articles. I'm just going to tell you the conclusion. We pay $7 for a dozen eggs at Pete and Jerry's at Whole Foods. We are paying the same amount as our parents and grandparents paid in 1940 at 35 cents a dozen. Okay. So basically he's saying everything's gone up in price, including salaries. They're trying to just say that's just the natural evolution of things. The correct conclusion is we are paying off with inflated dollars or devalued dollars because we do not have a stable currency. Things do cost more in terms of dollars. Don always talks about relative strength. The question is, has your specific salary, earnings, Social Security, et cetera, kept up with the increase in cost, or on the flip side, the decrease in value of the dollar? This is exactly what inflation is. It is only caused by printing too much money. Now, salaries have increased along with inflation, but have they increased as much? Almost always the answer is no. Now, conversely, in terms of gold, if you buy eggs, it would still be the same amount of gold or even less to buy those eggs. Eggs have not gone up in value in terms of gold, only in terms of USD and almost every other fiat currency. It is relative. Which one is finite and stable? By the way, the Fed's 2% target inflation rate is nonsense. They're trying to inflate their way out of the debt problem. It hurts retirees. Folks, if you have 2% inflation a year, that means in 10 years you're 10%, 20% poor. You understand that, right? All right. So anyway, with that, and then we had one other mailbag, and then we're going to go straight to the markets. This is the rest of that KP mailbag. You and Don talked a bit about volume not being as important as it once was. Bill O'Neill drilled into us the importance of volume, and I haven't heard anyone offer an explanation as to what has changed with that. Can you share your source? Thanks. And then this is me, and Don confirm this. It's just the index volume that we said was skewed and unreliable due to meme stocks like Gamestop, Roaring Kitties pumping it up, and penny stocks plus after-hours trading. Okay? You really have to make some serious time-consuming adjustments to arrive at the same comparable true volume for the indices, compared to how they used to calculate it, right? But for conventional stocks, is really so the leading stocks, the big, strong stocks that we delve in, volume is still very important to determine buying strength and selling pressure. So volume still is very important for individual stocks. It's just the index volume numbers that have been skewed over time. So we never meant to say that. If anybody got implied that, we're sorry about that. All right, Don, let's go into the markets because, you hear a lot of people say the economy's really starting to improve. A lot of people are saying it's slowing. The jobs numbers were pretty good today, although a lot of them were part-time jobs. And now they're the way that they count. 2 part-time jobs counts as 2 jobs, not just 1 job. So a part-time job has as much weight as a full-time job, unfortunately. So, but really, none of that matters. None of the economic data matters except with respect to how it affects the overall markets. So we've been in a strong uptrend all the way since November of last year. And then just about a month ago, kind of got choppy. And now it seems like it's firming up again. So Don, what gives? What's going on?
Sure. I was showing a 15-minute chart, but I want to get over the past couple of weeks I have been, but since the failed breakdown, and then re-breakout, I just want to document what's going on here. And this most recent up leg started with the CPI, a gap up on CPI. This was on May 15th. And we tried to rally above that level several times over the next couple of days, including a gap up on the NVIDIA earnings report. That gap up on NVIDIA took us above that 53.25 resistance level, but then we immediately failed. And that same day came back down to the bottom end of this range. We tried to get back above it a couple of times and then broke below it on the 30th and made a lower low on the 31st before having a big rally and a gap up to get back into that range. And then 2 days ago on Wednesday, just a clean breakout, a gap up and a clean breakout. No specific news. It happened overnight. Then we had a weak jobs report this morning. A strong jobs report this morning. Well, it depends on how deep you want to dive into it, obviously. But the headline number was more people hired. And that is not what the market is perceived to want, because they want the Fed to get closer to a rate cut. So we had a gap down, but the low was put in very quickly this morning, and we never got back below this 53.25 level. That's a pretty key level to monitor, because that's the breakout level. You get back below that level, it's a failed breakout, very similar to what happened back on May 23rd. So we're not quite at the highs of the day, but we're about the upper third of the daily range, and the breakout is holding. Now, that is all fine and dandy if you are invested in the NASDAQ 100 or the S&P 500, which are very top heavy, as we know, with these tech stocks, the Big Seven, the Magnificent Seven, whatever you want to call it. If you're in equal weighted S&P 5, can't come anywhere near close to make a new high yet. You're forming a triangle here, which may break higher, may break lower. But even worse, mid caps and small caps underperforming. And with the higher rates this morning, yields ticked up on that employment report, as well as the dollar. The small cap index, which we took a long in earlier this week and stopped out this morning as it broke below the low of the range and the 50-day moving average. You can see the relative strength here. So the market is, from a breadth standpoint, not fantastic. Small caps lagging, mid caps lagging. The Dow is lagging because it's more of a defensive index. But if you are a passive investor in the S&P 500, you're at all-time highs. But you're being carried there by fewer and fewer names. We're always cognizant of the breadth. what's leading, what's not leading, and we take what the market gives us. And what it's giving us right now is is a positive picture on the NASDAQ 100 and the S&P 500, and those big magnificent 7 stocks taking us to all-time highs. So instead of complaining about it, we're going to take advantage of it. And if you're doing anything other than that, why? Frankly, it doesn't make any sense. So we tried to break down last week 3 times. We didn't. From failed moves come fast moves. That works on a failed breakout as well as a failed breakdown. We broke out on Wednesday and we're holding out. So we took some a little bit off the table while things got weak, breaking below the 21-day moving average, put things back on, put more exposure back on into strength, which is typically what we do is from an index standpoint is sell weakness and buy strength. And individual names often will buy them on pullbacks to support levels. We just got an alert there, NVIDIA over 1,200. I mean, that's not bad news. Big 10-for-1 split coming for NVIDIA after today, so that's going to introduce some volatility next week. But this is very typical of the stocks that are carrying the indexes, the S&P and the NASDAQ 100, to all-time high. Another one to take note of, Apple has been a laggard for a while, but it's been strong on a relative and a price basis over the last month since report, because there's a big phone upgrade cycle coming to take advantage of AI features, and that's why Qualcomm's rallying, that's why Apple's rallying. Apple obviously a big part of the index. As you can see all these blue bars here, it looks like 12, 14, 15, 16, up 16 out of 20 days or more on Apple since the earnings gap up. So you go with what's working and avoid what's not.
Don, I want to. So I'm gonna go out. I want to say something. I'm gonna go out on a limb here. I want to get your advice. Okay. So the common knowledge on Wall Street and what they're telling you is you need diversification. You need to spread out. Yes, and here's what they're saying. Listen to the look. Yes, the large cap U.S. stocks have been clobbering every place else, and they have been for a while. And it looks like it's continuing to this point. But you need to go put money into international, to overseas, into small caps, whatever, for diversification, for safety. I would tell you, I'm saying, if as long as you have a sell discipline, if you're diversifying into weak sectors that are doing poorly, to me, that seems like you're adding more risk in the portfolio. You're adding more things that are doing poorly, and you're putting a drag on the portfolio. And by the way, when it hits the fan and it gets ugly, all the correlations grow together and they all go down together. So right now, large caps are going up while some of these other sectors are going down. Now, some of them are going up a lot less, but some of them are going down. To me, anything that's going down is risky. So if it starts going down, that's why we have a sell discipline. We're not going to let it go down too much. But this idea that you have to be super diversified, especially in a narrow market, seems to me to add risk. I think it's less risky to have a, quote, narrower portfolio, but make sure you have a discipline to exit, but also have a discipline to look at other areas when they start becoming in favor. You know, at some point, it won't be U.S. large cap equities. It'll be something else. But for right now, so what's your opinion on that?
Well, it's not only things that are going down, but things that are going up on a slower relative basis. I drew 2 lines here, the beginning of February and basically today. And if you look at the relative strength line here, although this is the US, this is the Vanguard Total International Stock Index, the price is higher. On a relative basis, it's exactly the same. So this is the equivalent of being in the S&P 500. But if you look to the left, look at the massive underperformance of international stocks. You can't necessarily tell it by looking at the chart, but you can always tell it by looking at the relative strength line. And they've been weaker. We've documented how they've been weaker for 1 year, 3 years, 5 years. I mean, you can be diversified all you want. All you're doing is costing yourself money, and you are plenty diversified in the S&P 500 because 40% of the revenues for the S&P 500 companies come from international. So by investing in those companies, you're taking advantage of the economies in the world as well. It doesn't necessarily matter um, where it's domiciled. I mean, you can take advantage of international by going with some strong individual stocks if you want to, like ASML, semiconductor company, great stock, strong company, Taiwan Semiconductor. They've got a political overhang, but that hasn't stopped the stock from going to all-time highs. And NVO, another international company that has a fantastic chart and fantastic product. So it's no different. You can own the international index if you want to underperform. You can own the international leaders if you want to outperform.
Well, here's the other thing, though. Think about this. Which is riskier? Small caps, if we go into recession or we get in trouble, small caps, international, especially with the currency translation risk also, not just the market risk, or the largest U.S. companies in the world that have the strongest balance sheets and have the most cash flow. In other words, those large cap U.S. stocks, if you're talking about equities, U.S. large cap stocks are considered the least risky. So the argument that Wall Street is telling you is diversify away from these stocks that are acting very, very well and are theoretically less risky by their market cap and their profits, and go diversify into weaker, much smaller, much less stable companies so that you can be less risky. That just doesn't make sense to me, especially in this market.
On a long-term, very long-term basis, small cap value historically outperforms, but that outperformance is based on a 5-year period after the tech bubble burst. Small cap value massively outperformed the large cap indexes. Since then, they've, for the most part, been in line, or small cap value lagging. But there are people that pay a lot of attention to the markets, and there are people that go completely hands off in the market, and they rely on advisors such as ourselves to make those decisions for them. There are modern portfolio theory people that think it's normal to lose 30, 40, 50% of your portfolio because historically it always comes back. That's not who we are. They'll tout the importance of factor investing, especially small cap value. That's not who we are either. We take a look at the market across 3 time frames. To us, the long-term time frame is the 200-day moving average. So, 10 months. And all bear markets occur if you break below that level. And as long as we're above that level, we're going to be actively looking to make money on the long side of the market. If things get weak and we break the 50-day moving average, obviously we back off and we let our stocks and our stops for those stocks take us out of the market, not anything that we have an opinion on.
Yeah. Now, so taking that a step further, so let me clarify. When the small caps are doing better on a relative basis, or even as good as the S&P are doing well, then the risk reward, then that diversification story works, and it makes sense to me. It would work, and it would not only enhance your return, but would reduce your risk. But when these more aggressive sectors are doing poorly, or doing weaker, I think you're actually increasing risk by going in those riskier sectors. In other words, I don't mind taking risk. I just want to be overcompensated for the risk I take, right? But so look, I'm not a gambler, but if I go to Vegas and I've got a 6 and the dealer's got an ace, I need to fold. I may win that particular hand, but if I bet that hand over and over, I'm going home in 5 minutes. If the dealer's got a 6 and I've got an ace or a jack, that's when I want to bet a little heavier. Okay. Right now, small caps in emerging markets and international have a 6 and the dealer's got a jack. Large caps are the jack, large caps are the ace, and the small caps are the 6. When it flips, that's when I'll flip, and that's when I'll change my mind. All right, Don, what do the guys got, or what do you got?
We're going to go to Connor first, and he's going to take a look at the solar sector.
Yeah. So I've mentioned this a little bit before, and going to kind of walk you through like the thought process and how this kind of played out. So pull up the weekly of TAN. This is the solar ETF. And when you look at the weekly, you can clearly see this sector has been in a clear downtrend for years now. And it's been like we're talking about, huge underperformer, right? But there was some telltale signs. So that line rate, relative strength line was in a clear downtrend. But what stood out to me was it had that undercut right below that weekly support spot. And from failed moves come fast moves. And when you're looking for reversals, the undercut is my favorite type of reversal, because when you think about the psychology behind it, a lot of people had stops right there. Price shoots below that level and then rips right back up. And the market always wants to fool the most, right? And so when you saw that undercut, it gives you a clear line in the sand. So that happened at the 40 level. And, you know, if you're wrong in this sector, if price undercut that level. So it had that undercut of the 40 level. And then when you take it another step further, you look at First Solar chart, Don, there was many other stocks in the sector that made you believe the undercut was real. And First Solar was definitely one. While the ETF was making a new low and then undercut it, First Solar was crafting out a very nice multi-month base. And when you look at the daily, you can see huge bars of accumulation. Price was meandering sideways for quite some time, and then the relative strength line started to build higher lows. You had volume pouring in, and the moving averages started to slope up and get aligned. And you notice that in the bases, the moving averages will be very tangled, and price will fluctuate in and out of the base, which it did here. But seeing all those volume spikes, and then once it finally broke out, huge volume came in, and this has arguably been one of the strongest stocks in the market. And this fits into the narrative that we've talked about on the show previously. When solar stocks first caught our eye, they were like the worst industry group in the market. And now as they've ran up, we've been able to capitalize on that move from think solar's like the 12th ranked industry group now. And before it was, 60, 70. So it's had a huge move up. And now when we look at the chart now, this is forming a high tight flag after that huge run up, and can't really ask for more. It's staying extremely strong. And then next one, if you look at NXT, this is a recent IPO and more so new merchandise. If you go to the weekly, Don. And so this one is another name that stood out. It's been pretty choppy in this space, but it found support at that 200-day moving average, and now it's coming up into this downtrend line. And when you look at the daily, it's got, it had that big move up, and now it's consolidating the gains. And this has less overhead, right? There's a lot of solar stocks with a ton of overhead, but this is one that is slightly below the highs, and it's showing great strength. And it's in this right side of the handle, so maybe it crafts out a little bit more before moving higher. And then the last one is Enphase, ENPH. Now this one has not broken out yet, so you could call it is a laggard, but relative strength line has started to slope back up. But what we like here is the stage one base. This is similar to First Solar before it went on that huge run in the last 2 to 3 weeks. And what I'm looking at here is, ideally, I'd like to see it break out of that upper trend line on volume. And one thing to note is that I really like how the moving averages are starting to flatline and slope up. So with the break on volume and getting over those moving averages, and yeah, so that's a quick summary of the solar sector.
Yeah, this is a good example of what you were talking about, comparing it to NXT about overhead supply. There certainly is a lot of it
Yeah.
on N phase, but you like to see the laggards in the group forming bases like this. There are always going to be members in the group that are going to lead, and First Solar and NXT are doing that. But this is a very nice long base that N phase is building, and their fundamentals are improving dramatically too. 163% earnings growth for 2025, and we know that a stock's success or failure is tied to the industry group that it's in big time, and so that's what we're seeing with these. Good stuff. Ted, let's take it over to you. You've got 4 slides to show the group today.
Yep. So in your general market segment, you kind of talked about breadth deteriorating. So just wanted to showcase some of those charts, showing some of those bearish breadth divergences. And then I just want to talk about sentiment real quick, which could support a higher market. Especially, there's 2 scenarios that I'll talk about at the end. So on the screen, Don has the net highs and lows with the S&P chart and the NASDAQ composite. As you can see, I drew those trend lines in. On the price of the indexes, we're making higher lows and higher highs, but on the net highs and lows, we're making lower highs. And what this means is as the indexes are going up, we're seeing less and less stocks participate in making new highs. So in a way, that's definitely not exactly what we want to see in terms of net highs and breadth. The next chart, can you pull up the NASI? And pretty much the NASI is just a derivative of advancers and decliners. And it's pretty much same story here. The RSI line briefly touched overbought, and we're back in the neutral territory. The price of the NASI is back below the 10-day moving average line and in a downtrend. So pretty much as the NASDAQ's making new highs, we're having less and less stocks participate in advancing with the NASDAQ. And then thirdly, I have the S&P and the NASDAQ percentage of stocks above the 50, 150, and 200-day moving averages. And those are in sequential order from the top to the bottom. And like I was talking about with the net highs and the NASI, same story here, bearish divergences as the indexes are making higher highs and higher lows. The percentage of stocks above the 50, 150, and 200 are actually making lower highs. So from these 3 charts or charts I showed you guys, there's 2 things that we can kind of talk about. The first one is we're seeing bearish divergences. So eventually price perhaps will have to kind of come down and match what is truly going on under the hood of the markets. Or if the mega caps and the indexes continue higher, we can see that breadth expansion, which would just push the indexes even higher. So those are the 2 situations we're kind of looking out for in this department in terms of breadth. And then going on to sentiment, this is where it's a little more favorable. The CNN fear and greed was actually in the fear territory as we're making new all-time highs. And that's not exactly what you'd expect. You expect at least perhaps neutral or greed, but we're actually in fear. So there's still, from this particular indicator, and then AAII, where the bearish readings from yesterday are above the historical averages, and the NAM dropping after yesterday's readings. People are less invested now, and so that can be another boost if we were to continue higher to push the indexes and other stocks higher. And so there's many cross currents, as Don pointed out. Mega caps, the S&P, and the NASDAQ are making new highs, but mid caps and small caps continue the lag. The IBD Mutual Fund Index and the IBD 50, Don, if you want to quickly pull that up as well, they're actually forming a base here. And I think the IBD 50 is actually breaking out of one. And there's also another IBD 85 index, which is basing and acting well too. And these are typically the areas of the growth stocks and the areas we traffic in. So if this can start to emerge, breadth comes back into the markets, that can be a very favorable environment for us and the names we usually traffic in. So those are kind of just some of the things I'm looking at in terms of breadth and sentiment. we have FOMC, CPI, PPI next week. So just have to take it week by week and day by day.
Sounds great, Ted. Appreciate it. Welcome back from your vacation. Glad to have you back
Thank you.
With us.
Glad to be back.
What kind of withdrawals do you go through when you step away from the markets like you do like that?
Well,
involved as you get in them.
Well, I'll tell you, the withdrawals the first night, since it's a 6-hour difference, so we got there at 2 p.m. Hawaii time. I ended up going to bed at 8 p.m. Hawaii time, which is around 2 a.m. Eastern time. And so my body clock naturally woke me up at 3:25 a.m. Hawaii time, which is 9:25 a.m. Eastern time, 5 minutes before the market closed. So I caught the first hour the first day, but eventually the circadian rhythm adjusted, and it was difficult waking up at 3:30. But I still checked the quotes during the day, but just had to try to be more present with my family during vacation. So that was a struggle, but yeah.
good to be able to recharge. All right.
Yeah.
And that's it from the technicians today. You can take us on home.
Ted, I was wanting one of your slides to be you in a grass skirt with a lei doing the little hula dance. I mean, come on. All right, folks.
I never got to do that, but we did see other people. We did see some the luau. I think it's called that.
Hopefully you did get to do a luau, right?
Yeah.
You did get to do a luau?
Yeah.
Yeah,
we participated in that, yeah.
All right, folks. Well, listen, the moral of the story today is right now the market is narrow, and it's narrow in large cap U.S. stocks. Are you in the narrow? Are you in the right place to be? And by the way, those narrow stocks are making the most money globally, and they're doing the best. So is that risky or less risky, being too narrow versus diversifying away to things that aren't doing well at all or not doing nearly as well? And they have more risk. As long as you have a sell discipline, we personally are in the narrow. Folks, if you like what you heard, please tell a friend, tell a neighbor. Just go to revereasset.com. Tell them to go up in the right-hand corner. There's a subscribe button, and they can simply put their name and email address in. They'll get this podcast delivered Saturday morning. And if you go to YouTube, though, you'll get it before the market closed today. We're recording Friday morning around 11 Central, and it'll be posted probably about 1 Central for all the stock nerds. Also, you'll get Don's daily market insight video we do every night. The market is open, folks, and we do have the t-shirts coming. I haven't forgotten. We're going to have them pretty soon, and I'll show you that. Folks, you can email me at dan@revereasset.com or don@revereasset.com or Ted or Connor at revereasset.com. And you can always call us old school at 855 Real Wealth. We'll talk to you next week on your money, not their money, your money.
It's not about how much you make in the markets. It's about how much you can keep.